In this video, we're going to take a look at accrued expenses. Accrued expenses are expenses that the company has used during an accounting period, but not yet paid at the end of that accounting period. Typical examples of expenses that are accrued are salaries, interest, and taxes. So whenever you see salaries expenses, interest expenses, and tax expenses, these would be accrued at the end of a period. At the end of the accounting period, the company will recognize the expense and recognize a liability for the unpaid amount of the expense. Let's take a look at some examples. We've looked at this example in an earlier video, but pause the video and read the question. It says, a BC company has a 5-day work week that runs from Monday to Friday. Employees are paid the following Monday. For the last week of December 2020, the salary expenses for the week were $5,000. December 31st fell on a Thursday. The $5,000 for the last week would be paid on Monday, January 4th, 2021. It says under the accrual basis of accounting, what would be the salary expense for the last week of December 2020? So in this example, here is the work week, Monday through Friday. They get paid the following Monday. Payroll for the week is $5,000. Now we are looking at the last week of December 2020. And they told us that the last week, December 31st, fell on a Thursday. So if that fell on a Thursday, everything from Thursday on before fell into the accounting year 2020, and everything after Thursday is the accounting year 2021. So what we need to figure out is, this week is split into 2 years. What would be the salary expense for the week of December 2020? We know that the $5,000 of salary was for 5 days, which means salary per day is $1,000. How many days that week fell in December or fell in the year 2020? We got 1, 2, 3, 4 days. Therefore, we're going to multiply the $1,000 that they get paid per day times 4, and we end up with $4,000. So $4,000 is the amount of the salary expense for the last week of December 2020. What about the remaining $1,000? That $1,000 is the salary expense for 2021. So that was salary expense calculated using the accrual basis. So when the company is recognizing the salary expense, remember this has not been recorded yet. They're going to record it when they pay it on Monday. But because we are at the year end and we are getting ready to prepare financial statements, they have to make that entry in the books of accounting. These types of entries are called end of period adjustments or adjusting entries. On December 31st, the company will recognize $4,000 of salary expense and $4,000 of salaries payable. Because remember, the salary has not been paid yet on December 31st, so they're going to recognize the expense as well as the liability that they owe $4,000 of salaries. Let's take a look at another example. It says, Seymour Services experienced the following events during its first year of operations, year 1. Who are we? We are Seymour Services, and this is our very first year of operations. So therefore, as we started, our assets, liabilities, equity, revenue, expenses, dividends, all the accounts had 0 balances. Then they gave us 3 transactions. We'll look at them in a minute. And they want us to use a horizontal financial statements model to show how each event affects the balance sheet, income statement, and statement of cash flows. let's take a look at the transactions. Transaction 1 says, performed services on account in the amount of $88,000. So a lot of these transactions I usually give you things that we've covered before so you can practice. So this particular one talks about performing services on account in the amount of $88,000. So we, the company, performed services. You know that whenever we perform services, we earn revenue. So the company earned revenue of $88,000. But did we get paid immediately? No, we didn't, because it says that we performed services on account. That's the key word, on account. So if we perform services on account, we don't have cash, we have an asset called accounts receivable. So under assets, I'm going to have a column called accounts receivable. And we know that accounts receivable increased by $88,000 for transaction 1. Now, what else happened in the balance sheet? We know that we earned revenue, and revenue has the effect of increasing retained earnings. Retained earnings is a stockholders' equity item, so under stockholders' equity, I'm going to abbreviate here and say retained earnings. And our retained earnings is increased by revenue, so I'm going to put that as a positive $88,000. That took care of your balance sheet. Now let's look at the income statement. Did we earn any revenue? Yes, we did. We performed services and earned revenue of $88,000. So our revenue increased. Therefore, I'm going to put $88,000 here in the revenue column. This transaction didn't have any expenses, so revenue minus expenses. Net income also increased by $88,000. Now let's look at the statement of cash flows. Did we have any cash associated with this transaction? There's nothing in the cash balance, so there's no cash here. Therefore, the statement of cash flows is not affected. Statement of cash flows is only affected if your cash is affected, because the statement of cash flows only lists cash transactions. Let's take a look at transaction 2. Transaction 2 says, collected $35,000 cash off the balance of accounts receivable. So what they're doing now is they're collecting some of this $88,000. When we collect cash, our cash increases. So under assets, I'm going to have an item called cash. And our cash increased by $35,000, so I'm going to put $35,000 as a positive number. When we collected cash, our accounts receivable decreased because our customers don't owe us that much anymore. So my accounts receivable decreased by $35,000. That's all that happened in the balance sheet. We didn't earn any new revenue. This is collecting revenue that we have earned before. Now let's look at the income statement. Did we earn any revenue in this transaction? Again, we didn't earn any new revenue. We're just collecting the revenue we earned in transaction 1. Therefore, the income statement is not affected by this transaction. Now let's look at the statement of cash flows. Is the statement of cash flows affected by this transaction? Yes, we had cash, therefore the statement of cash flows affected. We had $35,000 cash coming in, so it's a cash inflow. And what type of activity is it? This $35,000 was collected from customers for earning revenue, so therefore that's a day-to-day activity and we call that an operating activity. Let's look at transaction 3. Transaction 3 says we recorded $49,000 of accrued salaries at the end of the fiscal year. So now we're at the end of an accounting year, and they're telling us that they're accrued salaries. What are accrued salaries? These are salaries that we have used up. So basically, our employees worked for us during the end of the year, but we have not paid yet. How much did they work for us? Well, they worked where we owe them $49,000 worth of salaries. So what we need to do is those $49,000 of salaries belong to year one expenses. Therefore, we need to record them and show that we owe those $49,000 worth of salaries. So how does this affect the balance sheet? We know that these $49,000 of salaries are salary expenses. Expenses have the effect of decreasing retained earnings. So we're going to go to retained earnings and show that retained earnings would have decreased by $49,000 because of these accrued salaries. It's a salary expense. Now, if we paid them, we would have decreased cash, but we haven't paid them yet. We owe those salaries. Therefore, we're going to show a liability called salaries payable. I'm going to abbreviate it. Salaries payable increased as a result of this transaction. Before this transaction, we didn't have any salaries payable, and after this transaction, we have $49,000 of salaries payable. Therefore, the accounting equation is still in balance, and it shows how the balance sheet will have a $49,000 liability and retained earnings will decrease $49,000 as a result of this transaction. Now let's look at the income statement. Did this transaction affect the income statement? Income statement has revenues and expenses, and this item was an expense, so therefore it does affect the income statement. We know that our expenses increased by $49,000. Therefore, I'm going to put $49,000 as a positive number under expenses. Did this affect net income? Yes, revenues minus expenses is net income. No revenue in this transaction, but expenses increased. Therefore, net income would decrease by $49,000. Now let's look at the statement of cash flows. Was the statement of cash flows affected by this transaction? No, it wasn't, because there was no cash involved in this transaction. The statement of cash flows is not affected. That's it for this video. If you have any questions, please let me know.